Sir, the following is the report speech for our group. My name is Mengxin, and my student number is P138091. Our group work is divided into three parts. The first one is the mean and standard deviation each stock. The second is the portfolio investment, and the last one is unsized stock. The average stock return is the average stock return is the ratio of the average return earned by investing in stock over a certain period of the time to the amount invested. And here is the calculation folio. By the calculate, we can get the follow number. The market average return rate, stock return rate is negative 0.21%, and the 1A stock is negative 0.08%, and the 2B stock is 0.26%. The third three stock is 1.78%. 40 stock is 2.85%. And from the calculation, we can get some analysis and suggestion. The first one is the share of the 1A and the average return exhibition active value, while the remaining stock demonstrate positive performance, indicating a pro outlook for the overall market and the superior performance of all companies compared to the market average. And the second is the amount all stock. 40 stock exhibits the highest average return, whereas 1A stock displays the lowest or even negative average return. This illustrates that the companies hold 40 stock have performed exceptionally well in the prevention period, although both stock yield positive return when compared to 2B and 3C. Investors can accept high return through the investing in 4D. And the last is this indicate optimistic view of the future development position for 4D will highlight the company issue 1A stock has underperformed in recent time and may still face option risk, deception performance better than the market average.
Through the calculation of variance and standard deviation, we gain insights into the volatility of the market and the four stocks. The market variance is 0.11% with a standard deviation of 3%. 3.34%. By the conclusion, the standard deviation, we observed that the value of stock 1A, 3C, and 4D stated the market standard deviation, indicating these three stocks are valuation unstable. Their price fluctuations are significant, stability is poor, and there is a high level of risk, possibly due to an unfavorable overall market environment. However, for stocks with high volatility, other factors should be considered, such as whatever there is international spare conclusion, causing sharp price fluctuation in a short period. In such cases, some relatively conservative investors may choose to stay away from these stocks. Compare these four stocks, we find the stock 3C has the highest standard deviation, including the largest price fluctuations, the least stability, and the highest risk. However, with the high risk, the return of stock 3C may also be the highest. Stock 2B has the smallest standard deviation among the for stocks is 3.05%, lower than the market standards deviation, suggesting the stock to be is relatively stable compared to the market. Its stock price remained relatively stable. Lower risk but potentially smaller risk. To have the comprehensive understanding of the understanding of the stock's risk and return, we also calculate the mean of each stock. The mean risk represents the average return of the stock for stocks 1A, 2B, 3C, and 4D. Their means are 0.2%, 0.1%, and 0.3% and 0.2% respectively. Finally, remember the stocks market investment involves a certain level of uncertainty, and short-term losses do not necessarily respect long-term returns. Therefore, investors should adopt a long-term perspective, focus, move on the complex process and comprehensive advantages.
Good morning, doctor. I'm Tyler. My number is P138097. Here is my part. I will analyze the stock deviation for stock 1A. The mean is 0.002 and the standard deviation is 0.026. This means that on average stock 1A has a return of 0.2% and its return varies by 2.6% from this average return. For stock 2B, the mean is 0.001 and the standard deviation is 0.022. This means that on average, stock 2B has a return of 0.1% and its return varies by 2.2% from this average return. For stock 3C, this means it is 0.003 and the standard deviation is 0.031. This means that on average, stock 3C has a return of 0.3% and its return varies by 3.1% from this average return. For stock 4D, this means it is 0.002 and the standard deviation is 0.025. This means that on average, stock 4D has a return of 0.2% and its return varies by 2.5% from this average return. To build an investment portfolio, we need to calculate the expected return and the standard deviation of each portfolio. For the two-stock portfolio, we can combine any two stocks. For example, if we combine stock 1A and stock 2B, the expected return is 0.003 and the standard deviation is 0.021. And for this three-stock portfolio, we can combine any three stocks. For example, if we combine stock 1A, stock 2B, and stock 3C, the expected return is 0.006 and the standard deviation is 0.042. For the four-stock portfolio, we can combine all four stocks, and the expected return is 0.008 and the standard deviation is 0.67. To analyze this stock based on the beta, to require the rate of return and SML, we need to calculate the beta of each stock. Beta measures the sensitivities of the stock to the market. A beta of 1 means that the stock moves in line with the market, while a beta greater than 1 means that stock is more volatile and then the market. The beta of stock is 1A is 0.68. The beta of stock 2B is 0.54. The beta of stock 3C is 1.02 and the beta stock 4D is 0.87. Based on the market return of 3.28% and the risk-free rate of 3.13%. That's all, doctors. Thank you for your attention.
Hello, doctor. My name is Wu Hao. My number is P138093. Let me introduce beta and required return. Beta calculation. Beta measures a stock relatively in relation to the overall market. The beta of the stock measures its systematic risk, or how much it tends to change in relation to chances in the overall stock market. So a beta of 1 means the stock price tends to move in sync with the market. A beta greater than 1 means the stock is more volatile
than the market. So and beta less than 1 means the stock is less volatile. So this is the step to calculation beta based on Excel. This one is the beta formula for me calculation. So the my calculation result is the beta values are stock 1A is 0.8, 2B is 1.1, and 3C is 0.6, 4D is 1.7. Uh, this is a line chart of beta for each stock. So stock 4D has the highest beta and is the most volatile relative to the market. Stock 3C has the lowest beta and moves the least with the overall market. Stock 4D has beta greater 1, so it's more volatile than the overall market. While 10% market charge drives a 17% stock price charge. Stock 1A and 3 are beta less than 1, so they are less volatile. 1A 10% market charge drives just 8% and 6% price charge respectively. Stock 2B has a beta very slow to 1, so it tends to move similarly to the overall market. That's why the required return. The required return for the stock zombie is systematic using the capital asset pricing model. So this one is return formula. So my calculation result is 1A is 3.26%, 2B is 3.41%, 3C is 3.19%, 4D is 3.83%. This is required return. This is line chart required return for each stock. So we say stock 4D has the highest required return, which makes sense because it has the highest beta. Investors demand high returns for high perceived risk. Thank you.
Hello, doctor. My name is Dingley, and my student number is P138099. And here is my part. Based on the formal data, we talked about the beta values of stock 1A is 0.8, stock 2B is 1.1, stock 3C is 0.6, and stock 4D is 1.7. The required return of stock 1A is 3.26%, stock 2B is 3.41%, stock 3C is 3.19%, stock 4D is 3.83%. And as we all know, we need to make a chart. And for this SMIO line, starts from the left 3.13 and tilts towards the upper right, representing the balance between the level of risk investors are willing to take and the expected returns. Making the stocks on the horizontal axis label the beta values for 4 stocks 1, 2, 3, and 4. On the vertical axis, mark the required rate of return using the previously calculated values for each stock. And here is the security market line. Plotting the positions of stocks, place a point for each stock at the corresponding beta value and the required rate of return. The point for stock 4 should be above the SMIO line because it is a riskier stock. Points for stock 1A and 3C should be below the SMIO line as they are less risky stocks. The point for stock 2B should be very close to the SMIO line as its beta value is close to 1. And here is the summary of these stocks based on beta required rate of return and SMIO. Stock 1A and stock 3C might be lower risk investments, but their relatively low required rates of return may suggest overvaluation. Stock 2B appears to be reasonably valued, as its volatility and the required rate of return are close to the market average. Stock 40 seems to be a higher risk investment, but its higher required rate of return may suggest undervaluation. That's all. Thank you.